Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, we've been warning you guys that things are starting to go south. Well, now we've got real good data to show you, and even the big boys are leaving. And you're going to want to watch this video because if they're leaving, you're probably going to want to be leaving too. Let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes. And if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that.
So Phil, I'm going to give you an analogy here. When they press olive oil for olives, the first squeeze is the best squeeze. And then after that, the squeeze gets more and more and more acidic until it's just not worth squeezing anymore for olive oil. That's what's happening in the market right now. This first chart I wanted to show you is just that we've reached peak insanity with this, what they call 0 days to expiration on options. And it's been wildly successful for not us, just the market makers. And there's a study that just was concluded. And where's Gary Gensler, by the way, Phil, right? Gary Gensler, the protector of the little guy. Well, let me show you how much Gary Gensler is clueless and how much money the market makers and the big banks sucked out of retail. This is the chart, which is amazing. They said, Phil, the only time anybody makes money on 0 DTE is in the first 10 minutes the market is open. If you're not engaged that first 10 minutes, you're losing money. And I think, I don't know if the number's on the chart there, but the average loss per day since this thing opened in October for retail is $383,000 per day. That's money directly taken away from retail traders into the big banks and into the market makers. You know, guys like, BlackRock and Susquehanna and all those, Citadel and those guys. So it basically was a scheme to extract money from, basically poor people, the retail trader, and, just fly straight in the face of what the mission of the security exchange. And the reason I'm talking about that is you heard that clown this week, acting as the paragon or the savior of retail. And here he is. He's just allowing the raping and pillaging of retail. Right. But they're not done yet, Phil. Now they're going to what's called one-day VIX. And it starts on Monday. You can't make this stuff up. These guys, so the extra virgin olive oil has been taken out, and now the guy's walking in the desert looking for water, and they're going to try to take his last cup, okay? And the problem is nobody is quite sure what this is going to do to market intraday liquidity or volatility. And people are like really confused, like what's really the value here? But what they're thinking is, and it makes sense to me, is that after the first, and because you and I, we trade all day long, is that by the time Europe closes, you might as well just walk away for 4 hours. There's nothing happening. You're just wasting your life. And I think they're trying to energize the intraday activity so they can squeeze out the last of the money that retail has. And you said something when this thing first started. What was it about with the commissions and stuff, Phil?
So yeah, if I can interject just for a little bit here. I think this is all part of a major plan, if you will, to get the retail trader to hold the bag as they exit the building. So phase one, as you brought up, was, as if you remember, the end of 2021 was the end of our bull market, essentially, right? But in 2021, they waived commissions at the brokerage houses. They waived them at TD Ameritrade. They waived them at E-Trade, everywhere. And we all kind of are scratching our heads going like, well, that's interesting because, I mean, that's their bread and butter, right? But we kind of figured that, hey, this seems like they're trying to suck in everybody. And sure enough, within a few months, relatively speaking, the market top, right? So now we have a bear market rally. I consider this the lower high of the rally. And here we go again with 0 DTE peaking just as we're topping out, I would say. So I think there's like, this is phase two of that process where you're getting the very last of the retail to come in, and you see this every single bear cycle, and then they're going to go ahead and dump on you. And I think we got a slide coming up that kind of proves that point.
Yeah, why don't we show these people this next slide? You guys will laugh. You would laugh if you're not already crying.
Right.
So Larry Fink, okay, you could forget listening to us. You could forget listening to anybody on the internet. You can forget Warren Buffett. This is the only guy in America that you should follow whatever he does. He is ground zero. He doesn't wake up in the morning and wonder if the market's going to go up or down that day. He makes the market go up and down that day.
Yep.
And he went ahead and he sold another 7% of his stock holdings. Look, if you think the stock market's going higher and your business is infrastructure and enabling stock activity, you're not selling your shares, okay? But he's bailing out. And the last time he had a purchase, this is even bigger than last time. The last time he had a purchase like this, Phil, was right before the pandemic really cratered the markets. Fancy his timing.
Well, you have to treat that stuff as insider knowledge. And it's not really technically insider trading. It's just that they see what's going on better than anybody else on the planet. He is basically your x-ray vision into what's going on behind the scenes of the stock market. So like Bob said, if he's 7% sale on this guy's portfolio is huge. I mean, he's taking a tax hit on it. So he's got to be seeing some major upside to selling here with the idea of buying back in the future. So to me, that's a major risk off signal, like you said, Bob. And you can't, if you're ignoring this, then you just hate money because that's a major sell signal for the market.
Yeah, I mean, look, this guy's not stupid, and he's selling up, and he's selling enough in advance that this can't get tagged to him later in any kind of lawsuit.
Right.
Because that's why they threw the zero DTE VIX out at you. They know we have a month or two of this shenanigans with the debt thing. But once this debt thing resolves, Phil, we have a chart to show people. It's really good explanation on TGA that I've ever heard. This is the Treasury General Account and why and how it affects the stock market. Yesterday, we were talking about how when the Treasury has to call for debt, and they're selling treasuries, the banks pick up what investors don't, and that sucks liquidity out of the market. But this is a really good way of explaining it. And this is also, too, for you dollar bears out there, this is why you're wrong, okay? The United States does not have to sell debt. They could just print their currency, okay? This is why they sell debt, and this is what strengthens the dollar, because the debt locks up, absorbs these dollars. So it's really a way in which they soak up liquidity, in the market, because they lock it up with rich people who aren't selling it, or institutions who aren't selling it, versus just every day waking up and just selling currency out there, which will create rampant inflation. This is their dam, if you will, Phil. You get the occasional spillway. But the point here is that once Janet Yellen has to start selling treasuries, it takes away the money she's adding to the stock market, and it turns the liquidity engine off for the market. So that's why TGA is so important. And it's just starting to get into people's consciousness. We want you guys to understand what this is and what it means, because everybody was raised on, the stock is based on cash flow of good companies over time. No. The stock market is based on how much liquidity is coming in from the government. And when the government cuts off that liquidity engine, stocks are going down. Because you can't justify the PE ratios of companies based on what, Graham Dodd, right? You can't justify it. The market's overvalued by 300%. So there's a reason why it's up so much. It's because of all the liquidity that's been poured into this markets over the last, 35 years. And this is just one piece of it that'll go away, that'll cause the stock market then to react to it in a negative fashion. I'll throw it to you.
Some people will say, well, she's issued debt and, the Fed's bought it. And, so that's been net positive for the markets. But that's the problem, is that the Fed's not buying the debt. It's one thing if the Fed's buying the debt because the Fed turns around and turns that into dollars back into the system. That's quantitative easing. They're in quantitative tightening, so they're not buying that debt, or at least not anywhere near what they were doing with, I think it was upwards of $80 billion a month. That's why this market was going up the way it was the last couple of years. That's over. So now when they issue debt, it actually goes into those that are looking for the security of having bonds and T-bills. And you have to understand too that people, because of the FDIC limits, people are looking for a safe haven for their money. So if they're buying treasuries and T-bills above and beyond what the FDIC insurance limits are, that's where big corporations, that's what they do. It's called short-term cash management. They have billions of dollars. They can't just have it in these savings accounts or bank accounts. They have to be more creative in order to fully secure their deposits. So they go to the shorter term treasuries and things like that. So when those companies are doing that, that's where their liquidity is going. It's not like she's issuing debt and it's going back in the market. And that's why you have to be aware of what are the conditions. Are we in a tightening condition or an easing condition? Because that vastly changes the way the market revolves around how she issues debt. And one way you can look at that is visually, and that brings up this next chart. Here you have in blue is basically the treasury's balance. Now, when the treasury balance goes up, she's issuing debt. People are buying the debt and she's getting the money, okay, Yellen. And then the effect on that is a negative effect on the S&P 500 there in the orange line. So when we're in a tightening cycle, the treasury going up is bad for the S&P 500, okay? Those lines there start, or those arrows start around 2022, which was basically the top of the market. And you can see that effect. And now over there on the left, you can see she's skirting the zero line, which happens from time to time. And it's usually right before the debt ceiling gets lifted. So, and she's getting a bump now because this is tax receipt season. And we're already starting to see the effects of the market kind of stalling out here. But once the debt ceiling gets raised, and you're going to see a similar spike to what you saw there around that blue arrow, you can see the massive effect it's going to have on the market. Now, mind you, the market hasn't been going up, okay? The market is treading water, basically. And so this is a much different situation than we went into 2022 when the first time that her balance shot straight up in the air. We were grinding higher, grinding higher. Look where we are now, going sideways. This market has no lift in it. And so when she starts to do this again, market's going to go down and we're going to take out those lows because you can see how large the drop is in the market. And taking out the lows from here is a lot easier than what we were at before in 2022 going down towards the October lows last year. We don't have very far to go to take out those last year's lows now. So this is why Bob and I have been warning that usually when you have this condition, the quantitative tightening, when the yield curve is inverted and then it bounces and starts going back up, these are all things that are lining up and you're going to see finally that final flush out in the bear market that takes out the lows. And it's good for you because you're going to have great deals. Just don't be holding the bag up here while that starts to roll over and happen. And yeah, we could push up one last time, one final gasp, but over the next 4 to 8 weeks, be very, very, very careful that when this thing starts to roll over, that you're not catching that falling knife because it's going to be very damaging to your portfolio if you do.
Yeah, and the only thing I'll say too, Phil, this is the reason why Powell raised interest rates up to give people an attractive option in the stock market.
Correct.
So, and here's the good guy for the government is that, unless it's all in your IRA, those treasury gains are taxable as current income. So people had money locked up in the stock market for years that weren't paying any kind of taxation. And with these treasuries now, 90-day treasuries at 5.06%, Phil. This is no-brainer stuff. Look, it's exceeding the dividend yield of companies like McDonald's and ExxonMobil, blue chips of blue chips, right? And so, you're a fool if you're not moving your portfolio to an extent where you're taking advantage of this, basically zero risk money, versus the stock market. And now when this thing really goes, you're going to see money pouring into these bond funds. And then it will present us another opportunity, which we'll share with you at that time. So this is actually these moves that are happening are going to be very profitable for those people that are aware of what's really going to be driving the moves here. And we intend to bring that to you.
Awesome. Well, that's going to do it for us today, guys. We hope you enjoyed this information. Let us know your thoughts on this video. What did you get out of it? What are your thoughts going forward on this market? Other than that, have a great weekend. We'll see you guys back on Monday. Thanks for watching. Please hit that like button and smash that notification bell and set it to all if you could. Would really help us out. Take care, guys.
Trade Genius.